Thank you. Yeah, it was about 53 years ago I was sitting in one of your seats here. Hopefully I was in class. I wasn't always in class, though, I have to admit. But I have fond memories of being at UCSB. I was actually here 4.5 years, and I had a semester someplace else. I was in the 5-year program. I could never understand why people left Santa Barbara. And so I stayed an extra year. I'm going to give you a little background of what's created the background, the data for this contest. And I'm going to tell you a little bit of the comparisons of blackjack and the S&P 500 and investing in the market, and how you can use similar strategies in one versus the other. I played, this is my first investment experience. I took $500 and I went to Lake Tahoe. I actually played blackjack from 1971 to 76, really 76. And I played 5 years, and I played 50 days a year. And I used a strategy that was developed by Ed Thorpe. And Ed Thorpe, actually this came from an academic article that was written in, I think, 1958. And everything that we've done here, and you'll hear, has come from, there's something that came from the academic world that is in these slides. And what Ed Thorpe did is he said that he first determined what was the basic strategy. That is, what do you do given your 2 cards and the dealer's up card? What is gives you the maximum payoff? There are really 4 different decisions you can make. You can hit, stand, split, or double. And so he determined what was the maximum expectation of those 4 alternatives, and that became the basic strategy. So you had to memorize this little chart. And then the second thing he did is he looked at taking out cards. If you took cards out of the deck, let's say you take all the aces out, instead of having basically an even game, if you play on the Strip in Las Vegas, you have an even game, but if you take all the aces out, you actually have a disadvantage. And that disadvantage is about, you'd lose $2.72 for every $100 you bet. But on the other hand, if you took all the 5s out, you'd actually have an advantage. You'd win about $3.29 on average. So the idea is here we have like 10 indicators that determine the expected value of a blackjack hand. I think there are 10 indicators. There's some number of indicators that indicate where the market's going the next day, the next week, the next month, and the next 6 months. I took the money that I had in this game that I was able to make in playing blackjack, and I moved to another game. I actually moved to the Pacific Stock Exchange, and then to the Chicago Board of Options Exchange, and I essentially bought undervalued securities and sold overvalued securities. But I was always fascinated with timing the market, and I felt there was some indicators that actually were predictive of where future returns would be. And so in 1981, I actually presented a paper at a gambling conference, and I actually presented it in the ski mask, if you can believe that. And the reason was I was still an active blackjack player, and this conference was held in Lake Tahoe, so I wasn't going to divulge who I was at that time. But I compared the returns of timing the market to the returns of playing blackjack, and to making markets and options. And what I concluded was that even though there was great potential to time the market, that in fact the risk-adjusted returns of playing blackjack and being an option market maker were greater. It didn't mean that I could make more money doing that, because the market, the amount of money that you could deploy and get into action in playing against the casinos or against in the options markets, which is relatively small markets relative to the equity markets in general, was a smaller amount of money, but your return on risk was greater. So I stuck to, I said, okay, I'm going to forget about market timing. And so for the next 20 years, I said, I'll just concentrate on options, mostly on options. And so, as Mike said, that later we were operating in 26 exchanges in 9 countries, and there was this little firm in New York that said, hey, we think we need to be able to do that too. And so in 1999, Goldman Sachs purchased the firm. So I was pretty fat, dumb, and happy here now. I was pleased, and I put my money into an index fund, most of it in an index fund, along with bonds. And I had roughly a 70-30 portfolio. I had 70% of mine in risky assets, like the S&P 500, and 30% in less risky, in either bonds or treasury bills. And so what I did is, I was quite happy until there was a little event that occurred. And this event occurred probably when you were about 8 or 10 years old. I don't know if you remember your parents. If your parents had a stock portfolio, suddenly after a year, that portfolio was worth about half of what it was a year before. And so I wasn't very happy at this point in time. And I said, there's got to be a way that you can figure out where returns are higher and where returns are lower. And so I started to look at the academic literature. And I did find one fact, that there seems to be this stigma against market timing, and in fact, you need to just keep your money invested in the market, and you shouldn't get in or out. The costs are too high. One, the costs were high in terms of commissions. Now the costs are much lower. But there was this stigma against market timing. And this is what Robert Merton, a Nobel Prize winner, said. He said, it's a fool's errand to attempt to do this. And so this occurred about a clip on CNBC where I was on. I actually came after Jack Vogel, who was advocating buy and hold.
Well, Jack Vogel, I think, was right, but the stigma of market timing has gone on too long. We've had some significant changes that have occurred since 2000. We've had this explosion of data, and at the same time, we have predictive analytics that permeate our lives. We have credit scoring, we have cars that drive themselves, we have police that then use predictive analytics to find out where crimes are going to be committed. So it's ironic that we can't use predictive analytics in our portfolios. Just as we have our cars being driven now by machine learning techniques, we should have our portfolios being driven by predictive analytics.
There are a number of things that have changed since this stigma, which permeates everything we do. What's happened is we have new data that exists that didn't exist in the previous century, and that we have new techniques. We have new predictive analytics and new machine learning, which I'm sure that many of you are very familiar with. And these techniques allow us to do things that we couldn't do before. So, and at the same time, we've had this change. The academic literature has also changed. So we have this explosion of data around 2000, both in terms of financial and non-financial, and also governmental data that we didn't have before. We got these new predictive analytics, and this has created this change in somehow about 2008, the articles that you saw before 2008 were very pessimistic about predicting the market, and then those after seem to have changed. It's a little bit like climate change. You got 99% of the scientists say one way, and now we have the majority of academic literature say that returns are somewhat predictable. This is an example of some of the articles. We've got John Campbell and Robert Shiller with a paper. Eugene Fama and Kenneth French, and then John Cochran. And during this time, 2008, Google Scholar became my friend. I continue to look at Google Scholar. And there's an article about every week or every 2 weeks that talks about some indicator, and the conclusions seem to be very consistent. It is somewhat predictable. That doesn't mean necessarily we know how to use that slight predictability in the optimal way. And that's what part of this challenge is about. But I want to go through some of the indicators that you may want to use, and I would suggest using in this contest. The Baltic Dry Index is an index of shipping around the world. Carriers are moved on various routes. And what this is a compilation of what the demand for shipping is around the world. And this is actually accumulated every single day. And we get this I guess we get yesterday's index today. We get a one-day lag. And what I'm showing here is 6-month returns and I'm looking at the left-hand side shows the entire data set, the middle shows the first half, and the right-hand side shows the second half. So you can see that the correlation has the same sign throughout. And I should have had the T-stats up here, but these border on statistical significance. Probably T-stats are around 2. They're not 3, they're probably something like 2. And then, so that's one indicator, but this is a transform. This isn't necessarily the Baltic Dry. This is the Baltic Dry Index over its 63-day moving average, which is approximately 3 months. So it's really the change in the Baltic Dry Index that would be a factor that you should look at. This is the Federal Reserve Bank Officers Loan Survey. And what it does, the Fed meets 8 times a year. And they set interest rates based upon inflation and unemployment. And these meetings that occur are a big deal. The media makes a big deal out of it. But they're usually anticipated what the Fed is going to do. So the interest rate changes really our research has shown that it is not indicative of future equity returns. But what the loan officers do is what banks are actually doing. And so when they're tightening credit, returns are less likely to be high. Price indicators. This is value. This is the author. Notice that every time we have some author or some backup for this. This is Robert Shiller, who came up with cyclically adjusted price to earnings ratio. And what we've done in this indicator, though, uses dividend to price, and it also uses price to book. So it takes these three values of price, and it uses a technique called principal components analysis, which some of you may have used. And what it does is these 3 variables would be highly correlated. So we get them into one variable using principal components analysis. Volatility risk premium. You may be familiar with the VIX, the volatility index. And the volatility index is a measurement of the implied volatility in the S&P 500 options. And it trades in real time, so you get this information all the time. And if you take that and you subtract off the realized volatility in the last 21 days, which is an estimate of what the volatility really should be, that gives you a measurement. When we take a look at the difference of those 2 variables, it says whether people are really fearful, if they're scared. That's another name for the VIX index. It's the fear index. that in fact when that's very high, that when people are really scared, returns tend to be higher. So what we did is we actually published. We're very transparent about what we do, and we published. This was published in the Journal of Portfolio Management, and this was a 6-month model. We actually have. I'm going to show you 3 different models here. This is the 6-month model, and what we did is we took the 20 variables from the academic literature, and we put those through a multiple regression that used something called correlation screening to determine which variables were included in the regression. And we did a walk-forward simulation. And that walk-forward simulation shows the returns over time versus buy and hold. And then we went on to produce a paper also with a 1-month model. And the 1-month model uses some of the similar data, but it uses it in a different way. First of all, we use something called weighted least squares, where we weight more recent data heavier than we do data that's sometime in a longer time in the past. And we also did something, we normalized the data. I think probably you've come across this. You need data in some form for these machine learning techniques to work. You can't use raw data. You need to transform them and put them into some kind of a normalized space. And here's the wealth of using this model versus the S&P 500, and the position is down below. This has a limit of a position that could be 0. It could be 150% leveraged. This third paper deals with discrete data, and those are data in 1s or 0s. And I want to concentrate on one of those discrete variables versus the continuous variables that we saw in the previous 2 models. These are the variables that are in there, and I want to concentrate on one of these. I talked about the Fed making decisions 8 times a year at this is called the Federal Open Market Committee, and there was an article in the Journal of Finance that said that prior to these meetings, and this data is in, I think this is in the data set. I'm not positive it is, the FOMC meetings. That may be one that we left out, but we should put it in. What this says is that these 8 meetings occur and people get scared of what the Fed is going to do, whether they're going to raise or lower interest rates. And so as a result, what they do is they actually reduce their exposure to the market in the days preceding these meetings. So you can see that there's a statistically significant positive return in those 2 days. And then so we include some variables like that in a discrete basis in this model. I suspect you clearly are going to have both continuous variables and the winning model is going to have both continuous and discrete variables. This is again, you can notice here that actually the returns in this model are lower than the returns of the buy and hold. But the return on risk is actually higher. And one of the things you probably are aware of, I suspect as data scientists, you're aware that if you have several models that are predictive, if you combine those models in some way, you'll get a better prediction. And so we've created an ensemble of these 3 models along with a couple other 1-day models to create our total signal. And this looks at the ensemble of what the returns would be if in fact you combined all the models. Now, But even though you have, we've done these somewhat sophisticated models, we're hoping you're going to come up with more sophisticated models than we have. We still, if we look at the returns of the benchmark versus our returns, even in 5 of the last 14 years, you'll see that we actually underperform the market. So this is a difficult problem that you're facing here, and it's one that we haven't completely figured out. So why are good forecasts important? Well, obviously, if you could actually get a better return, if you'd gotten some of you are on scholarship here, and whoever funded your scholarship, if they'd actually, for the last 30 years, they got a 200 extra basis points, you'd be getting double the scholarship. Obviously, that's an obvious one. But there are many other reasons that you'd want good forecasts. Some of them are from policy decisions, and others would be it's a whole variety of issues. But one of the things that, in order to implement one of these strategies, you have to, because you go through a lot of it doesn't always work. You go through a lot of losing streaks, but you do tend to be a contrarian in these strategies. When prices are low, you tend to be a buyer, and when prices are high, you tend to be a seller. And that effect will reduce the volatility in the market. So that's one of the big reasons that if all of society used these techniques, we'd have less volatility in our marketplace. So in summary, this is a difficult problem. We've got the stigma of market timing that you can't do it at all. And the question is, are Nobel Prize winners wrong? But if you believe academia and you look at the mass majority of articles that have occurred in the last 10 years, they do say that returns are somewhat predictable. And so, but the question is, they're somewhat predictable, but how do you use that? How do you really use that in a strategy that works? So what we're looking here at, we have decided to make this forecast a one-week forecast. You're trying to forecast the return on the S&P 500 5 trading days ahead. And what you're really, I should have mentioned, I need to mention that this is the equity risk premium. The dependent variable, the left-hand side variable, is in fact the S&P 500 minus the Treasury bill rate. It's what you get paid to assume equity risk. And that's the dependent variable in the contest. So you're looking at a one-week model. And we're hoping that you're going to find some kind of new relationships, that you'll transform this data into a form that will give meaningful predictability. No, this is all daily data. It's all data that's available, at least, and what we make our decision right before the close. And one of the reasons we do that is there's tremendous liquidity at the close. There's almost no transaction costs at the close. So this data is all daily data. That's the data sets you're going to get. Well, that's an interesting idea. If you could get that brings up a question of whether we could get that data. What you would be, and part of this contest though is finding new data. We're going to give you a data set. We don't have that data. If you could find that, and Alex is going to go through this in terms of the actual, the best forecast is one category, but then there's the most creative solution. And that would certainly be a contender for the most creative solution. If you were to gather some of that data, and there will be office hours too that we can get some of this data to you too to help you. The blackjack career. Well, my brother-in-law in about 1970 said, I keep going up to Tahoe and I win almost every time. I win like, I don't know, well, I know the statistics show you should win 2 out of 3 trips that you take on a weekend. So he's winning something like that. And he says, I'm making money almost every time. I pay for my vacation every time I go to Tahoe. I said, you're an accountant. That's ridiculous. You wouldn't be playing at the $1 table. You'd be playing at the $5 table, $100 table. And so I said, well, okay, I'll go try it. And I took it a little more seriously than he did. I really studied all this stuff, and then I'd read another book about it, and then I'd call the author. I'd call the authors. I actually know Ed Thorpe very well. So, and you'd think, well, if you call the author, why would you call the author? Why would you bother him? He is so excited that you read his book, chances are. So don't hesitate to call the author if you have a question. But so I played for about 2 or 3 years on my own, and then I ran into some other people who were doing the same thing, and we actually formed a team. And you may have seen the book the movie 21, the MIT team. Well, there were lots of teams, but it ends up I'm involved in an organization. Well, I'm not involved, but I get invited to something called the Blackjack Hall of Fame dinner every time. There are only 120 people that get invited to this. I'm honored to be included in it, and it's well documented that my team, the team that I was on, I was a member of. I wasn't the organizer. Was actually the first blackjack team that was successful. So I went on 74 to 76. I was playing a team. And then I continued, even though we got barred seriously, we couldn't play anyway. We were in the Griffin Detective. There was a private detective agency that had a book. So we actually we ended up finding one of the guys in the detective agency. We made friends with him. We got copies of our mug sheet from the detective book. It was pretty interesting. So, but there were many blackjack teams, and finally, about 2000 or so, the casinos sort of got wise to the game. They figured it out. They were a little slow coming to the party, now it's difficult to play in the state of Nevada. Nevada really knows. There are still games in riverboats and Indian casinos around where the casinos haven't quite gotten the word, but it's a tough game right now. Thank you.